Well, the Federal Reserve fattened up its balance sheet during the recession and embarked on a bond buying program in an effort to juice the economy and lower interest rates. As we reported Friday, the president of the New York Fed hinted that it might be time for the central bank to slim down just a bit. But as Steve Liesman reports, it's a tricky thing to do. Not a lot of precedence here, and it could leave investors vulnerable.
For sale, trillions of dollars of treasuries and mortgages on the books of the Fed's balance sheet that it doesn't seem to need anymore. Now that the economy seems to be recovered, so much so that the Fed is now raising interest rates, Fed officials now are starting to talk gently about reducing the size of its $4.5 trillion balance sheet.
There is interest among FOMC members to start to shrink that balance sheet in a gradual and predictable way.
Increasing the size of the balance sheet during the financial crisis was an answer to a problem. The Fed had already cut rates to zero, but the economy was still weak. So the Fed purchased trillions of dollars of government bonds and mortgages to drive down interest rates and try to drive up the stock market. Now, 4 times the size of what's normal, the balance sheet is a potential problem in itself. It risks creating more inflation if not right-sized for a stronger economy.
Let's say they have a 5-year plan. They need to get the balance sheet down to about $1.8 trillion. So they need to get about $2.5 trillion off the balance sheet.
The plan is fraught with risk. The reason the Fed is raising interest rates before reducing the balance sheet size is it admits it doesn't know how to calibrate a decline in its balance sheet with the effects on interest rates and the economy.
We think it's much easier in using that tool to communicate the stance of policy. We have much more experience with it and have a better idea of its impact on the economy.
Investors are going to be listening closely. Too aggressive a plan could be a major selling event. So the best guess, the Fed announces a plan this year to gradually reduce the size of the balance sheet and doesn't actually do anything until later this year or early in 2018. For Nightly Business Report, I'm Steve Liesman.